And now with this great storytelling, the events itself are the storytelling of the WWE. So this is a proven formula for us that we're excited to jump into. This is sports entertainment, very close to our core. The deal's long-term. We're super excited about it.
So Sarando is very excited about what this could mean, but despite all of this and the excitement, the optimism, our next guest maintaining his neutral rating on the stock. Let's talk about it. We want to bring in Jason Bazinet. He's Citi's managing director, joining us now. So Jason, it seems like Netflix is almost firing on all cylinders. An extremely strong quarter here for the company. Lots to be excited about, especially when you tie in the recent deal that they have with WWE. Why are you staying on the sidelines?
Well, our neutral rating had three elements to it. We were a little bit nervous about the fourth quarter revenues of this year. We'll see if that's still true, given this very strong number. The second one is we think content spending has to go up next year. And they were explicitly asked on the call if they should sort of step off the accelerator on content spend, generate more free cash. And they said, absolutely not. We want to spend more as long as we continue to grow. So I think that part of our thesis is still intact. The third element of our downgrade was really the potential that they do M&A. And it was very interesting on the call yesterday, the CFO mentioned for the first time that they're sort of under-levered relative to their ideal capital structure. So it sort of hints to financial firepower to go potentially do a deal above and beyond the $7 billion of cash that they have on the balance sheet.
What is the characteristic of a deal that would make sense for them to do?
Well, they've dabbled, of course, in mobile games.
Sure.
They've also spoken publicly about the lack of intellectual property that exists within Netflix. Mm-hmm. So we've always thought a AAA game publisher like a Take-Two that has strong IP like GTA and has a big, strong mobile portfolio with Zynga would make a lot of sense because you'd kill two birds with one stone. You'd get the mobile games and you'd get the IP.
Jason, when it comes to the fact that, and we heard from the executives in the call, that they're not interested in linear assets, not exactly a massive surprise there. But when you talk about maybe some of the pressure that the stock could face if they don't live up to some of these expectations or the guidance or what some of your colleagues on the street are looking for, what do you think that downside risk then could look like here for Netflix if they do continue to spend at a higher rate than maybe what's being priced in?
Yeah, the street goes back and forth. Sometimes they look at earnings, sometimes they look at cash flow. I mean, the most common framing that I hear is sort of if you sort of rolled forward 1 year and you had $20 of earnings, some investors say, well, I'd put a 20 multiple on that if things falter, and that would get you 400. Other investors say, well, $20 a share, I'd pay a 30 multiple for that, and then you get 600 a share. And so you can sort of see at 540 where we are today, it doesn't strike me as particularly compelling.
Jason, when you talk about that free cash flow, some of it seems like it's going to come back to the pricing power here. And they did acknowledge this on the call last night. We do have a brief clip of them talking about where some of those fees could move a little bit higher or moderate higher for customers. Let's take a listen real quick.
We will continue to then monitor other countries and try and assess, when we've delivered enough additional entertainment value. We look at engagement, retention, acquisition as the signals there, so that we can go back to members and ask them to pay a bit more to keep that positive flywheel going. And we can invest in more great film series and games for those members.
So what type of pricing power from this point would you need to see from Netflix in order to change your type of positioning currently on it?
Yeah, I don't have any qualms with sort of the value consumers are getting with the level of engagement. So I think we'll probably see mid-single-digit pricing growth across all of the countries on average.
How does that translate into some of the subscriber growth as well? Do you believe that kind of moderates lower in terms of the year-over-year percentage, or kind of stays the same?
Yeah, so our forecast has about 10% top-line growth. So it's about 5 units of volume, 5 units of price to get to the 10% growth. The reason the stock is reacting so positively is the real debate among the buy side is not so much whether they have pricing power. The real question is, what is the magnitude and duration of the two main subscriber growth metrics, which is the ad tier crackdown, password sharing crackdown, and the ad tier, right? And so when they guide to sort of 8 or 9 million subs and they do 13, that's telling the market, hey, this has a lot more legs to it, could be higher magnitude than we thought. And so that's where the real debate is, net ads, not pricing.
Jason, where do you think Netflix falls when we talk about the streaming wars that are ongoing right now? Lots of talk about consolidation, what exactly that's going to look like, what Netflix needs to do in order to remain on top. Where do you think they lie right now, given everything that you've been saying, valuation, stock performance recently, compared to some of the rivals?
Well, Netflix won. I mean, when the stock was 200.
Is there any threat to Netflix when we talk about anyone that could really challenge them here?
I don't think a real threat to Netflix. I mean, we're sort of still maybe a third of the way through the transition from linear television to streaming. So there's plenty of runway for them to go. So I don't really think of it more as a competitive threat. I think it's more about the incumbent media companies actually generating profits in their streaming efforts. Right now, they're all generating losses, right? That's what makes Netflix special.
I mean, well, you have Nelson Peltz and Tryon initiating and following through on an activist campaign saying they're targeting to achieve Netflix-like margins of 15 to 20% by fiscal year 2027. Is Disney going to be able to get to the same type of margin profile on its streaming as Netflix is currently seeing right now?
Yeah, the former CFO of Disney used to talk about 20% EBIT margins being sort of the long-term target. So that's a bit below. Netflix is talking about 24% EBIT margins this year. So I think moving in the right direction, but maybe not to Netflix level if you don't have that level of scale. One of the things that I think is so interesting about Disney, where we are buy rated, is I have not had one person on the institutional investor base ask me what Disney's EBIT margins could be. The entire narrative is losses getting to break even, and that's going to happen this year. But no one's asked what happens next, right? Peltz is asking it. We're thinking about it. The stock certainly doesn't reflect it.
What do you think is next?
Well, I think I'm going to start getting inbound questions from investors saying, well, why couldn't they do 5% margins? Why not 10% margins? Because Disney is an earnings story. So if you're generating no EBIT from streaming, implicitly the street is paying nothing for Disney's streaming business. That's just wrong.
Jason, we could talk about this all day with you. Jason Bazinet, who is the Citi Managing Director. We know you got to get back to some of those client calls as well.
Absolutely.
Thanks so much, Jason.
Thanks for the time. Yeah, you bet.